The 12 p.m. news is proudly brought to you by Health City Cayman Islands. World-class healthcare within your reach.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry, and I'm delighted to be joined in the studio this morning by both Adam Butler and Georgie Loxton. Good morning to you both.
Good morning, Simon.
Well, we are on the precipice of making fools of ourselves this morning, because we're going to, at the end of the show, going to talk about what we think might happen in 2023. But before we do that, we're going to be the wisest people in the world to talk about what we think happened in 2022. And with the benefit of hindsight, we shouldn't get that wrong. Is that true?
Yeah, I don't know.
It's a long time ago now, though, Simon.
Well, we are still in 2022, aren't we? No, but you're right. It has been a convoluted year in many respects, hasn't it? And I think the one of the purposes of this show is just to try and tease out some of the information or some of the things that have happened in the year, so that perhaps we can learn from that and we can perhaps use that in our decision making, our analysis as we look forward into 2023. And so the question I wanted to start the show off is either a question of what was the biggest thing that happened in 2022, or what was the most surprising thing that happened in 2022 from your perspective. Do you want to start that one, Adam?
Sure, yeah. I mean, I think what was most surprising is just how...
That we got through 2022?
Well, we're not through yet, so let's not jinx it. But that the markets were so resilient in the face of what was an unbelievably hostile environment. I mean, we know mechanically that, equities are supposed to do well during periods of abundant liquidity, benign inflation, and reasonable growth. We've actually had tremendous growth, but we had, the kind of inflationary shock we haven't seen in about 40 years. And here we are with major U.S. equity indices. The Dow is plus or minus zero on the year. So equities actually fared pretty well. Safe bonds, I think, were probably the big surprise for many people, right? We put some portion of portfolios in bonds ostensibly because that's sort of the safety valve. And global bonds are down 10, 15% this year, depending on the duration. So it's pretty amazing. Just to see markets behave in ways that you sort of expect mechanically for them to behave, but in an environment that I think many people found really surprising, because we haven't seen anything quite like this since really the 1970s.
Well, it is the first inflation shock in most people's adult lifetime, right? There's no question that we've had the most benign levels of inflation and declining prices, declining levels of inflation for 15, 20 years, and that's been a catalyst for equity markets. And then an equity market shock, high inflation, not just high, but extraordinarily high inflation, as you say, was not correlated with a massive collapse. Well, it did to start with, but then there's been a recovery because people think, well, it's over.
Yeah.
I think you're absolutely spot on. I think when you look at actually the environment of the last 12 months, the market has fared quite well. It could have been so much worse when you think interest rates have gone through the roof very, very quickly. Yes, we've had the highest inflation since the 70s. We've had a war, a terrible war that's impacted really the whole world in the sense of what it's done to inflation. And as you say, some parts of the market are actually up. You look at the value stocks, those cheap stocks, they're actually up on the year. If you've been stuck in the technology stocks, the big US and small US tech growth stocks, you've had a pretty bad year. But if you've stuck to the old rules, the rules that always apply, the world always changes, but the rules never do, and you've stayed diversified, and you haven't panicked out, and you've just stuck to the slow and steady wins the race. It's not been a great year, but it's not been terrible. It could have been a lot worse.
So that leads me to a question I have in my own mind, and perhaps you can help answer it for me, which is, we've gone through this abhorrent supply shock in many respects. We've had unexpectedly nasty price increases in commodities, in transportation, and part of that is Ukraine, Russia related. Part of it also, though, is China's, until recently, ongoing supply side shock, which is just not supplying a lot of stuff, not letting people into factories, not letting people to move about their business. But that's now somewhat remarkably changed overnight. So does that mean that we're in for a period of increase in supply in a lot of products, simply because those people can actually get back into their jobs or travel around and allow transportation links to operate again, which could mean we actually have quite a dramatic supply side, whatever the inverse of a shock is, but supply side benefit, whereby you actually start to see potentially rapidly declining prices in certain assets because you've suddenly got a huge amount of people producing products back onto the world market.
Yeah, I mean, I think we've seen that already in the sort of back half of this year, where the inflation rate for goods has all but collapsed. I mean, the most recent reading for the goods side of the financial statement came in with disinflation or deflation, right? I think the year-over-year price of goods was down by about 3% in the most recent CPI reading. So, we had a massive goods-led inflation earlier in the year, as you say, on this massive supply shock and logistics wrangling, et cetera, at the ports. That has largely been relieved, and we're having goods deflation. Well, what has been, I think, a little surprising to many is the persistence of services inflation, right? And some of that's got to do with home prices and rents. But also, I mean, governments around the world put a huge amount of money in people's bank accounts during the pandemic as income replacement. And so the top 3 or 4 quintiles by income in the developed world still have a huge amount of excess savings that they, we're still 2 or 3 times where we normally expect to be in terms of savings in bank accounts.
Those people don't generally spend as high a proportion of their income as people in the lower quintiles or quartiles.
That's true on typical goods, but they tend to be big spenders on services, right?
And they haven't
travel,
stopped, have they?
Discretionary health care, et cetera. Yeah, exactly. And they just keep
Have you heard from anyone who's been to Disney recently? I mean, I haven't ever been to Disney, but people that have been said it's absolutely mad.
Yeah,
and
completely
it's
mad.
never been busier.
Sorry, you've never been to Disney?
Never been to Disney, Simon.
So
Have you, Adam?
I've been
you've been?
He goes every second
many
week.
times. We're going in a week.
Well, apparently it's just packed, and people that normally go in October and say you can get good hotel rates and blah blah blah. You couldn't even get a hotel.
Yeah.
But there are some. So that's an interesting thing, because in the last, I think, 3 days or so, there's been 2 or is it 3 different airline companies who said they had a great September, they had a great October, they had a great November. Then all of a sudden, bookings in December have fallen off. So JetBlue said profit warning because they're worried about, or not worried, they've not seen bookings in December. They've got half-empty flights. Delta said the same thing. Are we playing a little bit of catch-up, and is perhaps the worst of the pain just around the corner, in the terms of the whole purpose of the Fed's actions was to engender a recession? I mean, there's no way you get inflation under control in the long run without actually causing a destruction in demand. Are we actually finally seeing that? Is that going to actually kick in December, January, February, March, and be a quite unpleasant winter?
Oh, Simon, I really have no idea. I mean, we were joking before we came on air about making predictions.
Yeah.
I mean, who knows? I don't think anyone has the answer to whether it's going to be a hard landing or a soft landing in terms of the consumer or the economy. I don't have that answer.
If it were to be, I guess the question then, though, is if it were to be a hard landing in the sense of quite an aggressive decline in output, a nasty recession, that might change the dynamics that you mentioned at the beginning of the show, which is we've seen equity markets really quite resilient, probably because they're of the belief that the Fed was behind the curve and therefore not going to respond as aggressively, and therefore just keep things in a relatively decent, calm state. But if they actually go too far, which is the want of a central bank, typically they often act too late, well, we've seen that, and then once things are under control, they keep going and push the economy over the edge of the cliff. If that happens, then we could be in for trouble, right?
Yeah, it's been a really strange dynamic it's this interplay between the Fed and markets. The Fed is trying to tighten liquidity conditions, and the market's speculative fervor continues to impress. There's this new phenomenon where people are trading what are called zero delta options, which are like options with 1 or 2 days to expiry.
It's 7:40 in the morning. Zero delta options are going on.
Yeah, I know, right?
My brain can barely comprehend it.
I know, but the point is that people are taking these massive leveraged bets. It's like it is truly the casino out there, and I think one of the major motivations of the Fed's action over the last year has been to try and quell some of that speculative fervor, which peaked in Q3, Q4 of 2021. Mm-hmm. And they've just failed spectacularly to do that. There's no evidence of any reduction. People are still out there gambling and treating the stock market like a casino. And so the Fed's trying to tighten liquidity conditions, and the market keeps loosening them by rallying. Credit spreads are tightening again. And so, it's amazing. If you look at equity prices discounted to current rates, we actually aren't discounting any reduction in earnings for next year. The entire compression in prices has just been an adjustment in discount rates. In other words, the market is pricing in higher interest rates, but they're not pricing in any lower earnings, right? So certainly the market is not forecasting any kind of earnings recession. I'm inclined to agree with you that we will eventually see an earnings recession, and we need to see that. That's what the Fed is trying to facilitate. But so far they've been unsuccessful.
At some point, and we've talked about this in terms of, it's a little bit of human psychology, but at some point the real world has to force the financial world to catch up with it, because yes, you can have bubbles, yes, you can have collapses, but they always center around the mean, if you like. And when I say the mean of the real economy. So if the real economy is for the next 20 years going to do okay, then markets will generally do okay over the next 20 years, on the vice versa if they're not. But yes, you can have froth and you can have bubbles, and we've seen that so many times. So to your point then, when you say, there's this financial exuberance that still exists there, if the real economy gets into some sort of difficulty, which is what the Fed is trying to cause, then presumably that causes financial assets to have to catch up.
Yeah, but the stock market is not the economy. The two things can be quite separate. And we saw that certainly in COVID, didn't we? That, the stock market is not the economy. And although, as you say, over the long run, the two things go hand in hand, because stock prices go up over the long run because earnings go up. I mean, that is the reason that shares of companies over the long run increase. It's because the earnings of those businesses increase over the long run. But in the short run, we don't always see a correlation between the two things.
That was probably the most, you mentioned COVID, when you think about it, that's probably one of the best learning experiences anyone could have about what the benefit of the stock market is that it doesn't necessarily respond to what might seem on the face of it calamitous situations.
No, I mean,
it doesn't need to.
Absolutely, the stock market, it does what it does. It doesn't have to do anything or respond to anything. It's sort of, it's just, have to remember, it's just, in the short term, it's just this collection of millions of people all operating through human psychology and emotions on completely different timeframes with completely different goals, and that plays out on a daily and weekly basis. And so trying to know how that's going to react to the economy is impossible. I mean, we can't even predict the economy, let alone how the stock market is going to react.
I guess even if we could predict the economy, that wouldn't necessarily guarantee us at all that we could predict the stock market.
Still, we would have absolutely no clue what the stock market would do in reaction to that. But just having mentioned COVID,
there's no point us having jobs, Georgie.
No, I think COVID is, for me and what I'm starting to read, potentially the dangerous thing out there, in that it's flaring up again, and that could be, everyone sort of wants to think this is over. It could be the thing that derails 2023.
Well, thanks for that optimism. We haven't even got to the second half of the show yet, and you've already brought that into it. Well, I don't want to quite dwell on that just yet. I just want to finish off this line of conversation about the Fed's actions, because it seems to me as though, it was yesterday, Powell mentioned that it was better to go further than it would be to not do enough. I think that was near as damn it his actual quote. And absolutely, when one studies economics, that's absolutely what you'd expect a Federal Reserve or central bank person to say. They're never going to say the opposite. Do they actually do that is a different question. But if he actually means that, then we're all going to be torpedoed below the waterline, aren't we? There's no way the economy survives that sort of situation.
It's to a hammer, everything looks like a nail situation. I mean, the reality is the Fed is not the right institution to manage. It wasn't the right institution to manage us through the lack of growth over the last decade. It stepped in every time the stock market was looking to normalize. The stock market has been in
the famous Greenspan puts and all that.
That's right, absolutely. I mean, they engendered this huge moral hazard in 2008 when they stepped in and they bailed out all these bad actors. Now I can absolutely see the argument for why they need to do the first step of that. Then they doubled down and tripled down with QE1, QET, Operation Twist. They bailed everyone out in COVID. And at the time, you can sort of see, I get it. We're shutting down the economy. We need to bring out all of our tools. And but what's happened, obviously, is each time they have tried to illustrate to investors that there's no risk in equities. And what we know from history is that equities go through long periods of zero growth, multi-decade, where they do worse than treasuries. And then they go through long periods of incredible, double-digit growth. And, I have a feeling that, we ended the 2020s with markets arguably at higher valuations, certainly U.S. equities at higher valuations than they were even in the 2000 tech bubble. And it's going to take a decade or so to work off those valuations, which doesn't mean that we're in for a horrible crash. It probably just means that we're in for a more volatile inflationary situation. You've got governments around the world no longer kind of coordinating the way they were in the last decade, which means more uncertainty about interest rates and economic growth around the world. You've got frictions in terms of trade. You've got the U.S. shutting down trade with China on chips, for example, right? They're clearly being hostile in terms of protecting IP. You've got this war in Ukraine. There's ambiguity about the way that the European Union is viewing the U.S. at the moment. You're starting to see some fraying around the edges there. And I just think that we're in for a bit of a different environment, and equity valuations are likely to normalize. And this is perfectly normal to see historically.
And what we were saying before we came on air was, again, the old rules of diversification. And yes, US equities may still be overvalued and we may be in for a hard time there, but the US stock market is not the global stock market. It's the biggest part of it, but there's a whole world out there, and there are a lot of equities where valuations are much more reasonable. And, if we look through history, yes, we've just had a decade where the US has trounced everything, but if you go back to the 2000 to 2010 period, that decade, US equities went nowhere, whereas international markets, European markets, emerging markets did quite well. And if you had a globally diversified portfolio during that decade, you did okay. And so we have to be so careful of that behavioural, bias of putting everything into the thing that's just done well, which would be US equities.
Yep.
But if you stay diversified, and US equities don't do so well over the next decade, you'll probably still be okay.
Mm-hmm. I think, to me, there's been a lot of talk about, and I'm going to this is going to link into your point about equities being able to do okay despite what seemingly is happening. So the Fed's putting up interest rates. It's going to put them up, let's call it another % at least, right? That's going to hurt a lot of consumers because it's going to be more difficult, more expensive to borrow. But when you look at companies and their actual earnings, yes, okay, if consumers spend less, that will hurt the companies they spend less with. But in terms of corporate costs, the actual change in interest rates doesn't often have quite the same effect, because a lot of companies borrow 5-year, 10-year, they borrow against plant, they borrow against equipment, and actually 5-year borrowing costs aren't that much changed today than they were a few years ago. They're a percent and a bit higher, but the Fed's put up short-term interest rates a lot. But 10-year, 5-year interest rates are now lower than 1-year or overnight interest rates. And now, typically, that's associated with people predicting that leads to a recession. It's an inversion of the yield curve. But what it fundamentally means is that companies, if they need to borrow to expand or to run their operations, aren't actually seeing higher costs. Yes, you and I might be with our mortgage costs, but equally, someone who's got a 5-year mortgage has no impact whatsoever. And that's, I think, often lost in the discussion. People say, well, interest rates are going up, that's going to hurt everyone equally. And it simply isn't the case, right? It will hurt those people that need to borrow short-term only, especially when we've got the yield curve that we have today.
Companies are incredibly resilient. I mean, when you invest in the stock market, you're buying bits of businesses. You're not buying casino chips, even though, as Adam says, people do treat the stock market like a casino. It's not. It's bits of businesses. And businesses, capitalism works because businesses are incredibly efficient, and particularly after they've been through hard times, which we've had. We had COVID. We've had periods where businesses have had to become more efficient. They've closed loss-leading, products and moved factories and all the rest of it. And that bodes well for the future, because it tends to happen that after hard times, companies come out much leaner, meaner, and therefore we see growth going out of that period.
Well, And you said there, after hard times, companies come out of these things leaner, meaner, or in jail. And you've also mentioned casinos. And I can't have a show talking about 2022 and speculating on 2023, whilst at least having fun at the expense of people who have landed themselves in jail. So let's have some fun at the expense of FTX and some of the crypto universe. Not all of it. I've often said on this show there's a lot of good technology underpinning it, but there's also a lot of froth associated with it. Was it inevitable that what's his name? What's his name?
Sam Bankman-Fried.
Thank you. Was it inevitable that he or someone like him was going to have been found out for having basically allegedly defrauding people?
Well, I mean, that's a tough one because, really, I think you can look at the entire crypto ecosystem as being kind of a giant Ponzi scheme, right?
It's like
because there's no
in that
intrinsic
sense.
value in any of the coins, right? Or at least you can't price them like you would price another asset, which has some opportunity to flow cash in the future, right? You might be able to say it's some analog to gold or a store of value. I'm not particularly sympathetic to that view, but I guess it was inevitable that the ecosystem would come under serious pressure because there was nothing really supporting it other than, faith,
and
speculation.
No regulation.
Yeah, it was poorly regulated. We knew that. That's why a lot of these exchanges were domiciled offshore.
In the Bahamas or Cayman.
And so I guess we shouldn't be surprised that something like this happened. I was certainly personally surprised that we had a fraud that was so explicit.
And with so many really smart people involved in it.
Yeah.
I mean, you look at the list of investors in FTX, and these were some of the biggest VC and investment managers on the planet. I mean, it was a who's who of the investment world. And you just have to question what these people were doing because
It's musical chairs, though, isn't it?
Nobody looked under the hood. Not one person.
You play the game until and hope you
Totally.
get out before the music
Everybody
starts.
looked at the next person and thought, well, they did their due diligence, and they looked at the next person and said, well, they're smart, they must have understood it. And it turns out not one person can have done any due diligence on that company because, what's his name? John Ray, the now acting CEO who, administered Enron, said he's just never seen anything as bad as this. It was like high school level stuff that he was doing. I mean, he was operating this business with QuickBooks and an Excel spreadsheet and WhatsApp chats or some kind of social media chats where they were loaning money between different divisions. And it's just insane.
It reminds me of Chuck Prince. Remember back in
Citigroup,
2007, and I think this is maybe where you were going, where
I have no idea where I'm going.
I recall. I forget who said that they were chatting with Chuck Prince, who was the CEO of Bear Stearns at the time, I think, and he said they said, you knew that these mortgages were junk, right? You knew these ninja loans had nothing behind them. You knew that the collateralized debt obligations that you were issuing should never have received the AAA ratings that they received. Why did you continue? He said, well, when the music's playing, you got to stand up and dance, right? And I think that sums up the what's going on in the crypto ecosystem. It sums up what happens in every asset bubble, right?
Well, I know. I mean, it's not a new story, is it? I mean, this is a story as old as time.
It really is.
I mean, it's absolute pure FOMO, the fear of missing out, and that's it'll happen again. It's happened a million times over. It's exactly the same story, just in a different bubble.
There was in some respects, quite annoying article on Bloomberg I read in relation to this. But as annoying as it was also so true. It was annoying because it said the first red flag should have been that this company was incorporated in the Bahamas. And then it went on to talk about the Bahamas' history with piracy. So that was just stupid. But the reality is true to say that if jurisdictions rush to change their laws to accommodate things they don't understand, so Cayman's done it. There's no one in regulator environment here in Cayman who understands anything about this, and yet they've got laws in place. Rush to do something and then allow people to do something they don't understand as a regulator. So you have no protection as an investor when regulators are doing things they don't understand, encouraging things. It's just absolutely madness. I think, wasn't it, the deputy CEO of FTX went to report to the Bahamas regulators to say he thinks there's a huge fraud, and they were surprised.
There's a tension between the need to regulate and the opportunity for innovation.
Yeah.
Right? I mean, these...
But typically good jurisdictions do these sandboxing type things. So Singapore has small scale things. Let's see how this works. Let's have tight regulation within the framework. You change a whole law and say this is the best place to do something we don't understand. That's just going to come back and shoot you in the foot, isn't it?
Yeah, and it really has shot them in the foot, hasn't it?
So who's going to look at the Bahamas as a place where that's a safe place to park my money?
Well, I think the thing that really shot them in the foot was this evidence that, they took out money the day before.
And gave it to...
They let all their investors within the Bahamas. I mean, did you see the email that he actually wrote to the regulator saying, if you like, I'll open up and let everybody in the Bahamas take their money out before we go into liquidation.
That was kind of next level.
That really is next level.
There's an expression called regulatory capture, and it means the regulator is so enamored with the industry that they're regulating that they don't think sufficiently about the supervision of it, and there can be no finer example than that particular
No, and
quote.
it doesn't give you confidence in the jurisdiction, does it?
I think it rightly should give people pause for thought about any jurisdiction that rushes in to do things it has no capacity to understand. I include Cayman, I include Bahamas, I include many places, and the UK has done the same thing in certain of its regulatory rules, and the US has, through, I guess, laziness in some respects and regulatory incapability, haven't done anything. Because it's
there's a revolving door that's well known, right, between the Treasury and Wall Street banks, the Fed and Wall Street banks, the FDA and the pharmaceutical companies. It's the same in the U.S. It's the same in the U.K. It's just more stable.
But I think the whole FTX thing, to me, just what's so fascinating about it is him. Like, how did he do it? How did he captivate these people? I mean, he was 29.
He did call it a Ponzi scheme.
Yeah.
He himself said
did.
that crypto is a Ponzi scheme.
Yeah, on a podcast, didn't he? I mean, he was 29 years old, and he sat in these VC meetings playing video games while presenting his pitch deck, and people thought that he was the next Warren Buffett. I mean, they thought he was a genius, and that bit to me is just fascinating. How he did that.
Yeah, the psychology of how you persuade someone.
Yeah.
Where he had 38 billion or something like that on paper, in the sense that he had a coin that he'd created, which he said was worth 38 billion.
Yeah.
That's the only reason he was worth. But I mean, we could
said
do that
so.
today. I could. Yeah. Well, let's slightly digress for a minute and a half. One question I wanted to talk about and maybe get a thought from you: the US dollar. It's been a surprisingly strong animal for 2021, 2022. Is that because the US is the least bad dog in the show, or is there something more fundamental that's going on? And what's the future for that? Because it's hurting the US's growth prospects, helping a lot of other people. But where's your view on that in the last minute we have left?
In terms of where the US dollar is going, I don't have a very strong view, but I will say that I was also surprised at the strength in the dollar. But also, I think you'd argue that it was the least dirty shirt, like Mohamed El-Erian's characterization in that way. If all of the other central banks are going to be more profligate with spending, less aggressive in fighting inflation, or their economies have less flexibility to allow the central banks to be more aggressive in fighting the inflationary dynamics than the U.S., then it does make sense that the dollar would rise to the top relative to other developed market currencies. Now, I mean, if you look at the dollar relative to emerging market currencies, the emerging market currencies have actually strengthened pretty dramatically against the dollar because they're in healthier shape than a lot of the developed economies right now. But I mean, gold is the big surprise here, right? If it's just that the U.S. dollar is falling in absolute terms or losing value in absolute terms, but doing relatively better in relative terms, we would expect gold to be doing better, but we're not, right? So I don't know. To me, it's been interesting and confusing.
Well, there you are. We are going to end the last show of the year on a matter of great unknown, an unsolved mystery.
Quite appropriately, I think.
We need a second Poirot episode to delve into this. Look, Adam and Georgie, thank you very much for joining on the last show of the year. We should have little balloons, or I don't know.
We should be wearing Santa hats.
I almost did.
I'm almost lost for words, and that's a thought that's caused me. I'm not sure I'm going to sleep well tonight at all. I just thinking of the thought of that. But thank you very much for joining. It's been an absolute pleasure. I look forward to redoing something like this. Perhaps we can do something early in the new year, talking about the chaos that's happened in the 6 weeks since we did this show. So thank you both.
Thanks for
Thanks,
having
Simon.
us.
Thanks, Georgie.
So finally, just before we depart and leave the airwaves for this year, a quick reminder that Money Sense is available for viewing through the CFA Society Cayman Islands webpage, on LinkedIn or on YouTube. To see this on YouTube, simply type Money Sense Cayman into YouTube and Bob's your uncle. Otherwise, follow the CFA Society Cayman Islands on LinkedIn and comment there if you have any questions or observations you want for the show, or email us at moneysense@candw.ky. With that all said, just remains for me to wish everyone a very happy and prosperous remainder of the year, and good luck in 2023, whatever that may bring.
Radio Cayman time check now, 8:01. This time check brought to you by our friends at Foster's.
Mode activated.